based on literally yesterday's data, the news changes. And this is why I always repeat to people, don't shop for rate, focus on strategies. Yes, the rate's important, that's what you pay. But if you're not working with a strategic broker, you're working with their bank, there's no chance on earth they're calling you back.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
All right, so we'll call this a little bit of a last minute, I don't want to say emergency podcast episode, but listen, there was a lot of data and a lot of information. And, we don't try to just focus, or I don't just try to focus on news and news only in this podcast. It's more about fundamentals. But the purpose of this conversation is that the fundamentals were just highlighted after the news from last week. And so I'm going to date this episode here, last week being the first week of August or the last week of July, specifically referring to August 1st/2nd, 2024. If you didn't pay attention to news, it was like just a ton of bricks just dropped onto the rate market. And a lot of people, I think, out there were hoping for something like this to happen, but maybe a lot of people just didn't think it could happen because the trends for basically for the entire year of 2024 so far is basically like a roller coaster that just keeps going up and then down, up and down, up and down. You don't really get that big incline, that big decline that you'd love to see. Yet, over the course of the last 5 weeks, we've seen that bond yield. And if you don't know, the bond yields are typically what impact fixed rate mortgage. We've seen that bond yield start to finally work its way down the mountain. And the news that I'm talking about that came out was basically, well, there was a lot of news, but the big part was the US jobs report, number one, and the impact on the marketplace. Now, we won't go too deep on all of that, but I do want to talk about it because I think it is something that's going to have a direct correlation to Canadian borrowers and the Canadian real estate market, and there's just so much into it. So, first things first, what you're going to note is if you were to go and look at a bond chart, like Canada's 5-year bond yield, and you look back, call it 8 weeks to May of 2024, specifically, you'd notice that the bond yields themselves have been sinking week over week over week. Now, aside from some minor spikes, it's been going down. And if you went back way further and you went back to last year in May, which was basically the height of the yields, notwithstanding the fact that we saw some big dips in October and November, so I guess that wasn't the height, but that was the high watermark last year, I suppose. We've actually seen, essentially, we've seen the bond yields themselves kind of go over, up, down, but they've been working their way slowly down the mountain, which is a good reminder of the timeline it can take for rates to come down, but more importantly, about the impact of the marketplace and what's going on. But what you'll notice is that in the last week, the yields have really literally dropped off a cliff, like based on the back of the Bank of Canada's announcement, dropping rates again a quarter point. And then this US data, there's a lot going on and there's a lot of factors to consider. So basically, starting out, the first thing, the US jobs report was not pretty. In short, the US joblessness wage increases didn't go up. Unemployment is exceptionally high. And overall, all indicators are pointing towards a US recession. That's right. Definitely, I'm going to use that word now. A US recession is what is being called for. And again, make no joke about it. I mean, the Bank of Canada will look at what's happening in the US. Fixed rates are impacted by what happens in the US. They are basically our big brother. And whatever happens down there happens up here. It's one of the reasons that the BOC probably held off on dropping rates for longer, was because they were doing so well. In addition to that, other factors to consider. The market in the US has completely just changed their projections. We are now looking at the US Fed, well, at least many are calling for the US Fed to start actually dropping rates and dropping them significantly starting in September. If you can recall, there were a lot of conversations just a few months ago about the US Fed not even dropping rates even this year. Now, expectations could be as high as 50 to 100 basis points. It's 0.5 to 1%. That is a significant change in the marketplace. And that is having a direct impact on mortgage rates both in the US and in Canada. In addition to that, we're also seeing investors panic buying bonds as fast as they possibly can, like they're going out of style right now. And for all those reasons, you're seeing the yields dip. And for all those out there who aren't sure about how this all works, I've talked about this in the past. Essentially, in short, fixed rates are somewhat priced on what happens in the bond yields. And although it's not a direct correlation because there's other factors like risk and profit to be considered, you will definitely start to see the interest rate market change and adjust. Not only the rates going down, but also what types of terms are changing. And that is what's notable here. You see, the better part of the last year, most people have been going for the 3-year fix because that's been the projection in the marketplace, the 3-year fix. But for the last month, everybody's been anticipating when are the other rates going to come down? What about the short terms? What about the floating rate, the variable? Not just variable, but floating rates. What does that look like? Well, we are about to see that market change. And I'll talk to that in just a few minutes here as to what might happen and what you should be considering if you're either renewing or refinancing. But more importantly, we're actually going to start to see the rates change, and not just the 3-year fix, but across the board. And based on literally yesterday's data, the news changes. And this is why I always repeat to people, don't shop for rate, focus on strategy. Like, yes, the rate's important. That's what you pay. But if you're not working with a strategic broker, you're working with their bank, there's no chance on earth they're calling you back and saying, hey, let's adjust your plan or strategy. Hey, let's adjust your rate. And this is why I think most Canadians shop for mortgages wrong. But anyways, without getting into that, as we talked about, the job market in the US was ugly, not looking very pretty at this point right now. And overall, you're starting to see that dip in the yield. So let's talk about what this means for the overall marketplace and how the rate market could change. Now, first and foremost, with this data and the data from last week, we already were anticipating the potential of the BOC to reduce rates more over the long term than what was originally anticipated, but maybe just faster than expected. The forward markets have slightly revised their projections, and now the projections are for us to see rates come down as much as 1%. As much as 1% in the coming 6 to 8 months. And in 1 year, 1.5% below today. That's right. So if you have a variable rate mortgage and you had, let's say, a prime minus 1% from a couple of years ago, and you were feeling the pain of a 6.2% rate per year there, you could be seeing your mortgage rate as low as 4.2%. If you stick with that variable rate, you could be seeing that within the next year. Within 2 years, we can be seeing rates 2% below today, and there is even a thought that could go lower than that. But for the sake of conversation right now, 2% below today would put it just below the target rate, which is 2.5% for the overnight rate. It would put prime at 4.7, which would make a lot of happy people with interest rates at that. You know, if you had a prime minus 50, sitting at 4.2. If you had a prime minus 1, sitting at 3.7, and on and on. And there's even some rates out there from back a few years ago at people at prime minus 1.2, prime minus 1.3. So some really, really, really incredible opportunities out there. So what does this mean in terms of revising the markets and what could happen? So basically, compared to just a week ago, like this is how fast things change. Compared to a week ago, it's possible that we're going to see the 2-year rates, specifically with insured mortgages. That means when you're putting less than 20% down, they're going to go down at least a quarter point. And this is notable because 2-year fixed rates have been holding high, and it could be an opportunity on the 2-year. We'll talk about that. The 3-year rates, maybe 10 to 15 points. Not a huge drop there because the banks have been fighting for the 3-year rates. There hasn't been as much money to make there, so the spreads are a bit shorter. The 5-year fixed, we're going to see a bit of a bigger drop there, somewhere around a quarter point if this holds. And, unsurprisingly, although this will impact the fixed rate market, there is a lot of sentiment out there that suggests fixed rates are not going to dip the same amount as the variable rates, and we could be hanging out somewhere in the 4% range for quite some time on the fixed rate front. But we'll see what happens from there. So, looking forward in the marketplace, like what is this? I'm not going to talk too much about the real estate market because that's another conversation. But if we were to look at, okay, which term is going to give us the best opportunity to save money for someone who's looking at projected costs and expenses looking forward. Now, you obviously have anywhere between the 6 months to the 5-year and beyond. There's not a lot of value right now in that short term, although there is the value of being able to wait out the marketplace. So you could go with, like, for example, a 6-month close term If it's an insured mortgage, as low as 4.5%, but an uninsured mortgage, call it 5% right now. It'll give you the ability to qualify for more money, and it gives you a lot of flexibility. And this is, again, insured. This is less than 20% down, and it lets you kind of chase the market down and see what happens, which is an interesting thought process. You know, there's obviously a cost to consider if you switch lenders at the end of that 6 months, but that's a cost consideration. Now, for people going shorter term, like 12 months right now, I mean, again, remember, every term there's a value benefit to it, but you would need a very low interest rate in the threes at 1 year, so 12 months from now, for the 1 year term to make any sense in terms of on paper interest costs. So not really a lot of value there. The 2 years where things are getting super interesting, and this is where I want to focus my attention. Now, most of the banks right now in the 2 years are in the mid to high fives, some are even in the 6% range, depending on if it's insured, 25, 30 year, over $1 million, anywhere between 5.5% to 6%, with one bank being in the low fives, a bank that you're probably surprised about, but one of the banks is in the low fives. This is kind of like my sleeper pick right now, is the 2 year, if you're not a variable rate fan. The 3 year, again, I don't think we see the significant declines in the 3 year rates, but I could be wrong. We will see some declines. The only reason for that is because the banks have been duking it out in the 3 year. And I think a big part of that is that they've seen this coming in. It's going to benefit them to obviously put people in the 3 years, specifically when it comes to those penalties it's going to cost people to break their mortgage early. 4 year terms, there is one value play. At this point right now, there is a significant gap, but there is a value play. There's one lender offering a value play on the 4 year, but other than that one particular lender, and the strategy there, honestly, is a penalty play, meaning like it's a relatively low cost, shorter term than the 4 year, and a lower prepayment penalty risk, which is a big consideration when you're trying to ride the highs of how do I negotiate the lower rates and terms. And this is the thing about all these conversations, is that in everything that I'm talking about, you need to be considering the penalty. This is the strategy. So what is the prepayment penalty? And if you're working with your bank, chances are they don't even know how the penalty is calculated. I talked to someone yesterday, said, oh yeah, it's going to be 3 months of interest. Well, I just did a calculation for her right after that, showing her that if rates were to drop by 0.5%, this would kick in what's called the IRD, interest rate differential penalty, and she wouldn't be paying 3 months of interest, she'd be paying 30 to 40 grand. So big difference there. Anyhow, 5 year terms, if you're looking at the 5 year, it's in the conversation for someone who's looking for steadiness, certainty. And the rates are getting a little bit lower, but the only play there, obviously, if you want to reduce your rates as time goes on, is you got to be conscious of the lender itself. And then last but not least, the variable rate. And I wouldn't say this is last, but right now, if you're looking at projected rates based on what could happen, the variable is numero uno, if you can qualify. And that's the big question mark. Can you qualify? Because right now, variable rate qualifications to get that stress test, you're still qualifying at 7-8%. So that's not the rate, that's the qualifying rate. So can you actually qualify for that? So honestly, and I think that anybody getting a mortgage right now, if you're not working with a licensed mortgage broker, or you're not a mortgage expert, you're losing 100%. And I know I'm biased in saying that, but I truly believe that after being through these cycles. Like, I truly believe that. I think what people need to look out for is okay, so if we're looking to go with a variable rate, well, what type of variable rate and how long am I hanging on? Because you got to be open to hanging on for the 5 year term first and foremost. The other factor is, do I have the ability? So here's some questions you have to look out for. Do I have the ability to borrow more money without a penalty before maturity? If so, what's that penalty? Are my payments floating or fixed? So are you locked into a fixed payment variable rate or a floating payment? That's going to be pretty significant for someone trying to ride the wave down on payments, which I believe most people are, especially if we're heading into a recession. We want to be looking for a lender right now, whether it's fixed or variable, with really good porting policy. This is massive, especially for first-time buyers getting the market. You could get some crazy good value plays in the next 6 months here in terms of real estate, I believe. And then if they, most first-time buyers are looking to move up in the next 4 to 6 years. I honestly, it's been even quicker in the last couple of years I've seen, with the exception of this year, just due to the fact that values haven't increased. You need to be looking at portability, and not just the ability to port, but what's the cost associated with that and how do you requalify? So many people miss the ball on that one right there. And then last but not least, what is the conversion cost? So if I'm switching to a fixed rate, or if I'm converting to a lower fixed rate, what are my costs to consider? So, I mean, that's a lot right there. It's a lot to chew on, but it's essentially a definitive guide of how to look at your mortgage options right now and have a conversation. So the question that you need to be asking yourself, if you're a real estate agent, the question you'd be asking is, okay, are these conversations being had with my client? Because this is going to impact their ability to buy, resell, or invest in 2, 3, 4 years, or even yourself. Is the advisor they're working with having these conversations? Is the bank having these conversations? Is anybody having these conversations right now? I got to know this, because what I find is when times of restriction, like when the costs get tight, people are less focused on the strategy and more focused on the price. And this is where people miss the ball. And I know I'm obviously empathetically pushing on this, and I know it's a big part of my business overall, but I truly believe in it. So if you believe in it, you need to be conscious of it. Whew. That was our first car cast, and it's not over yet, but that was my first cast here today. And objectively speaking, I want to hear your feedback. Did you like it? Did you find value in this conversation? Do you like this kind of stuff? Follow me on Instagram. You could follow my company account at Flow Mortgage Co. Or you follow me on at the Mortgage Pug. Send me a DM. Let me know what you think. Share this out if you found value. I'd like to show more people and tell more people about what we talk about here and educate more people. So my goal is to educate just one more family every single day. And if you could help me do that, that'd be amazing. If you're loving the podcast, leave me a rating or review on iTunes or Spotify. Thank you so much. See you on the next show.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.